Welcome back for another weekend deep dive where we're going to discuss the S&P 500, the stock market, and everything we need to know for the week ahead. My name is Justin, and I'm excited to be back with you again this weekend because last weekend we were off. One of the first weekends we've had off in probably a couple of years, and I think that what's really interesting now is that having less videos is actually making it a little bit easier to trade. So last weekend we went through and discussed whether the stock market crash was over. And in the purpose of this weekend's video, that's what we're going to try to figure out. This is the exact same image that I shared 2 weeks ago when we did the last video here. Just as a recap, again, the last video was published on, what day was this? This is 2 weeks ago today. We're recording this on Saturday. You're watching it on Saturday. So that's me right there. It's all white. We're back in heaven, right? Back in the promised land. Nice. So on June 26th, here is where we were. On June 26th, we were sitting right here. So we just poked through the new all-time high, right? We poked through the red line. And we can even see that here visually on the thumbnail. So the reason why that matters is because it basically means that the crash for right now is over. We now have more levels of support and we are further into the promised land. It appears for right now that the stock market crash is over. What we want to try to figure out is, again, like in every other weekend deep dive, there's always a reason to be looking for downside moves. But in a liquidity-driven rally, when the lines are pointing up and the trend is your friend and we're above every major average, making new all-time highs, and we're clearing resistance levels, we have to assume we're going to keep going higher. That's our base case. So what we want to try to figure out this next week, for this next week on this video is whether or not we're going to keep pointing up or keep trending up, or if we're finally going to point down. What I want to actually do is a little bit something a little bit different than I do in normal shows, because I think that what I'm going to try to do is frame the conversation in terms of what could actually drive us up or down this week. So there's two things that are dominating headlines right now. The first one being the sickness. And again, this is from the Washington Post. So take this with a grain of salt. But again, the Washington Post is a pretty liberal media outlet. So this right here is a pretty big shot. Opinion. Liberal democracies are running out of time to save the rest of the planet from COVID. So what we're looking for here is basically just that, again, this is an opinion. So whose opinion is this? Robert Zoellick has served as president of the World Bank, U.S. Trade Representative, and Deputy Secretary of the State. He recently published America in the World, a history of U.S. diplomacy and foreign policy. The United States, Britain, and the rest of the group of seven, the G7, cleared a low bar by pledging 1 billion vaccine doses to developing countries in June. This still means they fell short by about 10 billion doses. The world's in a tight race between vaccination and variants, right? Again, there's a lot of stuff happening in the rest of the world. So what they're basically talking about here is that the G7 strategy must go beyond merely promising vaccines, an updated plan for the next 4 months, leading to late October, a group of 20 summit in Rome needs 4 offensives: vaccine production, distribution, financing, and biosecurity. So what this basically means is that we need to make sure that we are mindful that even though it appears we are through the worst part in the developed world, I'm talking about the G7 or the group of 7 countries where more than half the country is vaccinated, up to 3/4 of people are vaccinated. It appears we're a little bit safer right now. At least in Canada, we are starting to reopen. Our home province of Ontario is actually going back to normal on July 16th. Meanwhile, in the rest of the world, they're actually going back into lockdown. So I don't know what's going to happen here. We know that the big stock market crash of 2020 was caused by the lockdown and the sickness. This has the potential to come back and bite us. So again, one potentially bearish thing here. The next potentially bearish thing is this. There's a couple of headlines that came out regarding the Fed report. So I'm going to go through these one by one and try to explain the story from my point of view. And again, I am not a personal financial advisor. I'm just some guy on YouTube telling you my perspective and my strategy, my game plan for the week ahead. Fed report. Structural vulnerabilities persist at some types of money market funds and bank loan and bond mutual funds. So what I have highlighted here is bank loan. And the reason why I have bank loan and money market funds highlighted is because we've been noticing some funky activity. What I mean by that is, again, 68 counterparts take 780 billion at Fed's fixed rate reverse repo. We even saw it crack 1 trillion this week, where the daily repos are now above 500 billion and sometimes up to 1 trillion. What this is doing is tightening monetary policy without actually doing removing quantitative easing or doing quantitative tightening. What they're doing is actually removing money supply without having to be hawkish, meaning that Jerome Powell doesn't have to do this. It's the banks doing it. The second part I want to focus on here is the bank loan part. And again, if you've been following the news this week, you know that Wells Fargo was telling its customers that it's shuttering all personal lines of credit. Why would they be doing that? Why would people be returning money to the Fed, and why would they be shutting down lines of credit when, again, that's how the banks make money? Do they not want to make money? Or is this type of business no longer profitable? Meaning, this is flashing us a warning that people can no longer afford to pay a line of credit. Line of credits are generally going to be a lower interest rate than credit cards. What that means is that, again, pretend, when we talk, maybe to try to make this very simple. So when we talk, I'm trying to think about how I can explain this in the most simple way. So let's think of it like this. I'm gonna use an analogy, and again, maybe I'm gonna confuse you, maybe I'm not, but again, something called junk bonds. So junk bonds generally yield about 5%, again, roughly 5%. So if you're giving away if you're lending money to junk companies and you're getting 5%, well, then we also have a default rate, which means the companies who are now going bust are going to zero. So if when they don't go bust, they pay you 5%, but your delinquency rate is less than 4%, you net out the difference, meaning the companies that don't go bust pay you 5%, and pretend 2% of companies go delinquent. Remembering these are junk bonds, right? Junk companies. So 5 minus 2 equals 3. You got 3% left over. However, if you're getting 5% in yield, and now you've got 5% or more in defaults, you're netting out 0 to negative, which means that business segment or that type of business is no longer profitable. I don't know if that's what's happening here, meaning that Wells Fargo is a pretty big a pretty big personal bank. And I don't know if they are basically saying that we don't want you using lines of credit because people are not able to afford it, or if they're trying to encourage people to start using more credit cards where you're generally paying 20% plus. A much higher rate of interest, which means that if now you got 20% in interest coming in, 20% of your customers have to go bust before you start actually losing money. You might make less margin, meaning that, again, 20% interest when you're right, 10% of people are going bust, you net out 10%, versus a line of credit where, again, maybe 5 or 10%, right? You're looking at 1/4 to 1/2 of the amount. So this right here basically just means that liquidity is being removed from the system. And when we're hearing that from the Fed is also talking about upside risks to the inflation outlook in the near term have increased. Well, if people don't have as much easy access to money, they're less likely to go out and buy things. If they're less likely to go out and buy things, that could mean that the inflation that we've seen so far has been transitory, and it could remain transitory. When they do things like this and they're removing liquidity from the system, it basically means that this money is not going to be lent out to businesses, lent out to individual people, or to companies. So what does that mean? We're getting tightening in inflation, less inflation right now. So maybe that's the way where the banks are trying to do this, so that the Fed's not going to be the boogeyman saying that, oh my God, we got to start raising interest rates, blah blah blah, inflation this, blah 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 that. I don't know. But what I do know is that, again, this could be what they are trying to do. They're trying to get the net effect of removing some of that easy liquidity without actually having to do it announced by the Fed. We've also heard that they want to reduce the mortgage-backed securities. And that is maybe due to the housing market having a really, really, really big move. So again, this is a risk. Looking over here, Fed report, prepared to adjust stance of monetary policy as appropriate risks emerge. So prepared to make stance on monetary policy. They're prepared to move at any time. They've told us a few times now. They've told us a few times they're ready to make a move. So we got to be aware of it. If they say tomorrow, let's go back to here. I forgot to touch on this part here. So what we have on Wednesday, and I don't know why they don't have it in here. So again, I just want to show one more thing here. Let me hop back over to Slack, because I know I showed a screenshot of this. We got Jerome Powell speaking on Wednesday. He's giving testimony. Why does that matter? This is the guy in charge of the Fed. What's the Fed saying? We're prepared to adjust the stance. And the reason why this matters is because, again, lawmakers are going to be pushing a little bit harder on Jerome than when they're having an FOMC meeting. So again, Fed chair testifies on Wednesday. So what that means is that he's likely going to get poked and prodded in terms of what he's planning on doing when they say we're prepared to adjust the monetary policy. What does that mean? I don't know what this means. So we're probably going to be hearing from Jerome Powell, where he's going to have to clarify and testify in regards to what this means. So just paying close attention to this. Again, Wednesday is the key date for us. We're going to circle back and talk about this a little bit later. Next thing we got here is that the White House says Biden reiterated that U.S. will take any necessary action to defend Americans and any critical infrastructure statement. So this is very interesting, right? This came out yesterday morning, July 9th, at about lunchtime. Again, this is Pacific time here. But we also noticed this. White House says Biden expects Congress to act on U.S. debt ceiling. So again, we're seeing a little bit of a story told here. Earlier, I told you the bear case, where we know that, again, the sickness is potentially going to be spreading. We're going to be hearing from the Fed's Chair Powell on Wednesday. And I don't know, right? Again, all this is potential. We got potential news, and then we got to watch for the reaction. So we should not be surprised that Wednesday could potentially be a quite volatile day. On the flip side, Friday is also monthly OPEX, monthly options expiry. That kind of matters. Why? There's a lot of money tied up on those chains, right? Got to get those chains. So flipping here to the next part, again, White House says Biden reiterated that the U.S. will take any necessary action to defend Americans and any critical infrastructure. We know the U.S. is crumbling right now, right? We got to start building roads and bridges. There we go. Looking forward here again. So how are they going to do that? Print more, baby. Raise the debt ceiling. Raise the debt ceiling. We don't need to worry about debt. And then the last thing here. Senate may work into August to pass infrastructure plan. Set the stage for huge spending bill. Whoop! Right? This game just continues to be entertaining. So over here we got Jerome Powell, we got Jay versus Jay in the ultimate showdown. Who's going to win? Is it going to be Jerome? Is it going to be Jay? I don't know, right? So we got Jerome and we got Joe. Jay versus Jay in the ultimate showdown. Who's going to win? The Bulls or the Bears? I don't know, but the lines are going to be either higher, down, or flat when we check in this time next week, next Saturday. Checking in on timer at about 12 minutes. And what this basically shows you is that we could dip then rip. That's what I'm trying to signify here. The base case is that we're just going to continue to go higher. If these headlines start dominating more, we have to be prepared for it. Why? Well, again, the reason why is because overnight here we heard from the Fed. We had the FOMC minutes come out on Wednesday. And then for some reason overnight, the rest of the world was more concerned about U.S. monetary policy than the U.S. was. The U.S. said, we don't care, new all-time highs. The rest of the world was like, oh my God, there's inflation in the U.S. Slam the markets down, right down to support. And ironically, it is right on our uptrend here that we had drawn from 2 weeks ago. So I've not updated this chart at all. So we pretty much came back down to support and bounced off. That is the most important thing for right now. So if we take a revisit to the uptrend at roughly 4,300 ES, which is the futures, or we push all the way down to 4,200, which is the 50-day moving average, we're not bearish yet. Why? We still have an inverse head and shoulders here. We're still above 41.23, and that's bullish. That's it. That's all we got to know. We'd have to slam down here by about 5% in 1 week to start flipping bearish. So maybe we're going to look like there's more bearish potential by the end of this week, but until proven otherwise, there's nothing here to tell us that we're going to be going down. This also adds a little bit of again, a wild card where U.S. adds China firms to the blacklist. We also note that the DDIPO in the U.S. is now being called on to be investigated in terms of what actually happened here. Over the July 4th Independence Day long weekend where we celebrate America, China had other plans. And now the U.S. is taking a shot back here. I don't know what's going to happen. All I know is that there's potential, right? Tensions are escalating. And that G20 meeting, which is coming up, and we noted earlier, right? That G20 meeting coming up in a few months, that is going to be important. The G7 is one thing. The G20 is another. So in late October, the group of 20 is going to be meeting in Rome. So again, what's going to happen here? We're going to probably see more posturing, and then the two leaders are going to be meeting. That's what I suspect. Biden also noted that when he had a press conference, I believe on Thursday, that cybersecurity is still an issue. And we're seeing even more companies getting attacked here. So again, I don't know what's going to happen. I hope for peace and prosperity. I'm just putting my critical eye on here and being aware of that. All right. And then finally here, I'm at about 15 minutes. I'm checking in here at the seasonality chart. So as of right now, we're sitting here at about July 10th. I'm thinking we're about right here. And what do we do? Well, let's have a look at the chart now. So let's go like this. Let's remove everything. Let's go to SPX. And then over here, okay, so now let's go back here to I'm gonna try to do this fast. So again, this might not be valuable. Again, I'm recording this. I don't do edits on my videos. I hope you guys appreciate that too. Why? I'm not trying to like edit the videos to show the version of the video that is gonna make me look smart all the time. I don't particularly care. So we were looking for a move up higher here the last time we checked in. We got that W. We were looking for a push up. We got it. Just got to move it over a little bit, right? Boop. There we go. We're all the way there. So what this basically shows us is that, let's go back to here and pull this over. And again, if you guys have not already, I'd really appreciate a thumbs up. And if you wouldn't mind subscribing to the channel, that would also be greatly appreciated. Those small little gestures go a very long way to support our new channel. And I really want to keep posting more videos. So if you guys enjoy it and want me to do that, please make sure to smash a thumbs up, support the channel, and also drop a comment. Again, I know I'm asking you for a lot, but I would really, 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 really appreciate it. I'll even give you my Canadian thank you and apology ahead of time. I apologize for asking you for support. I would really appreciate it if you could please smash a thumbs up, subscribe to the channel, hit the bell, drop a comment to encourage me to keep doing these videos. As a reminder, there will also be a private portion to this video that will be recorded for the members only. You want to get access to that? Click on the link in the description to learn more. But finally, looking here, so we now know that we are out of the woods in terms of the big dip in June, right? Why? Well, we're not in June anymore. So the June dip is over. The stock market crash is over. The stock market crash of July appears to be over. So if we look back to here, on roughly July 10th, we've now had that one dip down. And now it appears we are ready to rock it up. If we don't have any other negative headlines come out and we get the, right? We get the blessing from Jay Powell. So I don't know. We've already blasted into new all-time highs. We don't really have to go higher. So this right here pretty much completes. So we went back up to the new all-time high. So what could be happening is that we're already into this leg right here where we've now overshot to a new all-time high. Again, looking inside of here, we pretty much form a base where we channel sideways for a little bit, bouncing around near the previous all-time high. So previous all-time high, bounce around near it, right? New all-time high, bounce around in it, bounce off the previous top. That would pretty much correspond with, I don't know, like somewhere inside of here, where we've now actually pushed up. We could be in here, and we're gonna push up, and then potentially drop down into August. So to iterate what might be happening here, I see two scenarios. Scenario one is that we drop now. Scenario two is that we drop later. And again, I'm not calling for a crash. I'm calling for a higher low. So the crash could come if we could rally up into here if there are hopes of stimulus and none of these negative headlines come to fruition and Jerome Powell on Wednesday holds the line and does not do anything. However, if we hear about the potential for Jerome Powell to be making a move faster and he tells us exactly what that would mean, the market's gonna have to price that in. And the reason why it matters is because when the market prices it in, we go down. That's what happens. So if we price it in now, we can dip, and then into August, we can start focusing on fresh printing, right? Debt ceiling gets raised. So we raise the debt ceiling, we print a whole bunch more. Why? It says a huge spending bill. Potentially up to, I think it was like 6 trillion, something like that, right? 6. Not 1, not 2, 6. 6 trillion. Yeah, 6. Whoa. So if we print 6 trillion more in a liquidity-driven rally in a bull market where we're pointing up, where are we likely going to go? More up. Why? That's how it works. It's how it's been working for the last year and a half. Is this healthy? Is it normal? Of course not. Scenario number 2 is this. We don't do anything now. Jerome Powell does not hurt us. And then the way that we could go, so Jerome Powell doesn't hurt us. We dip down into the talks of stimulus. They start stalling out because that's how it works. We're working, we're talking, it's not working, we're not talking. There is a bill, there isn't a bill, blah, 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 blah. And then eventually it gets passed. So this way the market is allowed to chop up. We test the bulls, we test the bears into the month of August. They work through the month. Oh, we got a deal. Boom, all the way back up. Then we got Jackson Hole. And then we got the FOMC economic projections coming in September, and then we play it out here. So what I'm basically trying to say is that we are in the chop shop. The chop shop is identified by sell in May and go away. So I have a different chart up here, but I'll just do this really fast here. Just noticing the time as well. What do we do here? Not much. So between May and October, we don't really do much. So I don't really know why people are so gung-ho on trading this market right now. So inside of here, we got May, right? What do we do? Well, we go up a little bit, but from the beginning of May to where we dip down, so like this area right here, to where we ultimately start the month of October, where do we go? Basically nowhere. So this area right here is basically horizontal. What does that mean? There's no money to be really made in the index, meaning the broader market, between May and October for 6 months or half the year. So why are we so gung-ho on trying to time everything inside of here? You got to spend time in the market. Also have to know when it is time to trade and when it is not. So again, until proven otherwise, we're still pointing up, right? We still have an uptrend here. So even just looking at it like this, what do we have? Well, we have a consolidation pattern, right? We're going into an ascending triangle, and then we break up with a cup and a handle, right? Cup and handle, or even a dub, dare I say it, right? We got a dub here. Ooh, yeah. So that's all we're really looking for. We're looking for consolidation. And the fact the S&P is already up so much means that we don't really have to go higher. I'm not sure if I actually reviewed this in the last video or what we did, but Goldman Sachs has also kind of kept their base case. So maybe I'll circle back and do this next weekend. I'm going to make a note for myself right now. Goldman Sachs targets for next video. Well, again, I just know off the top of my head that Goldman Sachs has said that their base case is that we're not going to really go anywhere between now and the end of the year. They've called for a bull case. They've called for a bear case. I just don't have time to go through that in this video. Please drop me a comment if you're interested in learning more about that, though. Again, I think I've already reviewed it in Slack. If not, please make sure to let me know. I'd be more than happy to do that. All right, moving forward, because I got to make sure that we are a little bit tighter on time now. So I've talked a lot. I've said a lot of things. What I want to make sure of now is that people understand that I am deviating a little bit from the normal routine here. Why? Again, I'm trying to lay out the scenario for the next couple of months. And the reason for that is because I'm likely going to be away next weekend again. From July 18th to 21st, I'm going to be away from the screen. I'm going to make every effort possible to upload videos in a timely manner. I'm not sure if there's going to be one next weekend. So I want to make sure this video remains a little bit more evergreen, like this one here was last weekend, where again, it appears the stock market crash is over. Why? Well, 2 weeks ago, it was not easy saying that because we were just poking above the previous all-time high. And now, 2 weeks later, we are much further into that promised land. And the promised land for me basically just means new all-time highs. And what we have to keep in mind as well is that when we make a move to a new all-time high, all it means is that it's easier for us to go up than it is to go down. Why? Everyone is making money except for the shorts. It's just a matter of how much we're making. So people have price targets and profit targets in mind. So what they do is they just sell when those profit targets are hit. It's that simple. Last thing I would just note here is that we are seeing strength. So again, the QQQ or the Qs have powered up massively to a new all-time high. They could dip down a lot and we would not really even be bearish. It would be a retest of the previous all-time highs. That's the story here. So the market is led by tech again, right? Tech-led rally, normal strong rally. This is good for us if we're bulls, right? If you're a bear, I'm sorry. I'm sorry if you're a bear right now. Why? Right, new all-time highs again, right? You get a whiff of bearish action. Oh, time to go all in again. I don't know. So I do think tech has a little bit of an overhang with the fact that Joe Biden has also talked about, he did an executive action on Friday regarding big tech. We didn't really see a reaction, but we're seeing some negative bear bets coming in for big tech. So what that basically means is that, I forget what the name, the new person at the FTC, I believe her name is Khan, where she's very anti-Amazon. She's anti-big tech. She's made it known. I think the reason why the market did not sell off more for tech stocks is because what they're basically saying, they're voting and saying that, sure, you want to regulate big tech, but are you actually going to be successful? How are you actually going to prove that these companies need to be broken up? And what it shows to me is that the market is putting in the probability. They're placing bets. They're saying, we don't think this is going to pass. We don't think it's going to pass. Why? We're not selling off big tech. We don't care. We're buying some insurance, but that is it. So going over here to the S&P summary, I'll do this really fast and we'll circle back to talk a little bit more in detail. On the other video, I was talking about the potential for us to be going down to 415 to 420. That potential still remains. So I've talked about the catalyst that could drive us there, the lockdown, Jerome Powell and the Fed. potentially not having stimulus now, right? Kicking the can down to August. So again, that's what I'm looking at now. If we were to push all the way down to 415 to 420, which is my strong buy pocket for the next week here, that's a strong buy area. I would not see anything bearish on the monthly chart if we did that. I would also note that it's only July 10th. We still have 2/3 of the month left. If we power slide down to 415 to 420 now, we can easily rally back up into the end of the month to form yet another hammer. Look right here, where we have incremental higher lows, but that's what they are. They're higher lows. So right here, we got a low at about 370.38. Here we got 371.88. So all I'm calling for is the potential. Again, potential. If I saw this happen, I would be a lot more bullish on the market if it hit that 415 to 420 pocket and then bounced. Why? I think it's getting a little bit frothy up here. It's not that it's bearish. It's the only reason to be bearish right now is that we're too bullish. One more time. The only reason to be bearish right now is that we're too bullish. I don't really know that's a reason to be bearish. However, if we did push all the way down, we would get a technical test here on the apex, and that would be strong. So I'm looking for potentially down to 415 on an overreaction to the downside of a combination of the Olympics being shifted in Japan. Japan's been very soft lately, very, very soft lately. Fears out of the UK, fears out of Europe, and again, just a culmination of all the fear all at once, all coming together during monthly OPEX, which is going to be on Friday. So if on Wednesday Jerome Powell gives us a whiff of what we want, even if the US markets do not react in a bearish way, it does not mean that the other markets, meaning Europe and Asia, are not going to react bearish. That's what they did. That's what they did overnight on Wednesday into Thursday. They're like, oh, the US made a new all-time high. We scared. We so scared. We so scared of new all-time highs. They're going to sell it off. So that's what I think right now. That's the easiest way to summarize this. This monthly chart is incredibly bullish, right? Still pointing up. We're way off this even short-term moving average here, though. 305 is the 50 MA on the monthly. Yeah, 130 points lower. That's really low. We've not tested it either, right? Oof. So again, what we're looking at here, and again, just removing all these trend lines for a quick second here, what we're looking at is mean reversion. So if we've not spent any time near the 50 MA all the way back to the crash, what we have to assume is that when we start grinding up, at some point we will test it. Does not mean we have to test it right now, but look at this, right? Slow and steady, or the angle of ascent is much more sustainable. So when we come back down and test this here, it bounces, and then fails. Well, over here, we've pretty much just shot straight up. Let's actually flip this over to a log. It's a little bit easier for us to look at here. Right? A log is going to show us a better representation of what's happening here. Right? It doesn't have to test it. So it didn't even hit the 50 MA here for a while. But eventually we're going to have to do something, right? We're going to have to eventually test that line. When? I don't know. But when that hits, that's when the crash happens. It's not now. All right, moving forward. So we've gone through here. Let's have a look at the heat map. And the reason why I'm looking at the heat map is because, again, I was calling for tech-led rally into the last little bit. So looking at the one-year performance, again, everything is a green. It's the everything rally. Flipping over here to year-to-date, again, now we see that Apple's actually back to green. When we checked in last time, it was still red. So from red to green. And now we see that, again, there's a lot more areas that are actually green here. We also note that consumer defensive are actually flipping red. And entertainment like Disney and Netflix, Verizon, everything that worked well from home, meaning things that you need that are non-technology based, right? Buying food, food like Pepsi and Coke, food like Walmart, Procter & Gamble, right? I think that's Colgate, yeah. Not really going anywhere. T-Mobile and Verizon, people don't have to use their phones as much or not buying as many new phones. Why? They did that last year. Disney and Netflix, again, people appear to be streaming less. Why? You can go outside now. There are choices. Over here in utilities, again, that's generally going to be an offset for tech. And otherwise, it's bright green everywhere. Chips are down. Chips are mixed, actually. So now we look at the last 3 months. Right. Ooh, now we're seeing some divergence where there's actually pockets of red and mostly green. So big tech, right? Amazon, Facebook, Google, Microsoft, Apple, all getting greener here. Looking at the 1 month, now we see rotation. So that means that, again, the market can go nowhere because over the last 1 month or last 30 days, where have we gone? Let's have a look here. So today it is July 10th. Let's have a look here and see where June 10th we were. So on June 10th, we're right here, and now we're up by about another 2.6%. So for the S&P to go up by 2.6%, and with $1 trillion company basically all being up double digits, right? Tesla nearly up 10, Amazon up 13. Facebook and Google have already been powering up massively this year, so they're just stalling out here a little bit. Microsoft still up about 10, and Apple up 14. King Apple, whoop! If only someone told us, right? If only someone told us to buy Apple. If only. There we go. So the reason why these are able to go up 14% or 10% and 10% and 10% and the S&P only goes up by 2 is because the rest of the blocks are offsetting it. You're going to note that the green pretty much comes in inside of, again, medical devices, diagnostics, and then big tech. That's pretty much it. Looking at the last 1 week, it's the exact same theme here, right? Apple and Amazon, the two big mega cap companies I've been talking about. There we go, they're up. And then looking at Friday, they were not able to hold down these big tech into Friday, right? Barely red, green, 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 which meant all the options paid out. Apple actually even closed above 145. Microsoft closed above 275. Amazon closed above 3,700. Tesla closed above 650. Google closed above 2,500. QQQ closed above 360. SPY closed above 435. What does that mean? This is a strong market. This is a strong, strong market. All right, looking at time, I'm already at 31 minutes. What I'm going to do right now is start switching gears and start going faster a little bit. Start going a little bit faster, because I'm recognizing that I don't want this to be a marathon video, but I still got some stuff I want to go through. So looking over to here, what I'm going to do now is just have a look at these options chains. And let me go to here. And what I want to do here, I think I already laid some of my notes out. So what I'm actually going to do is just pull over Slack. You guys can see the notes inside of here. I don't really care. I don't think there's anything sensitive in here. So next week, again, these are preliminary notes. So what I want to do now is try to understand what I need to express to make sure I understand this. So for next week, we got Monday 435 and 436 call spread, and we got 434 or 435 put spread. We also got on Wednesday the exact same levels. Oops, that should be a 4, not a 5. I make typos. I have mild dyslexia. If you notice anything that is wrong, please make sure to tell me. Why? I'm human. I make mistakes too. So Monday 435, 436 calls, and 434, 435 puts. On Wednesday, we got the same levels, and over here it goes down to 432. So again, just noticing that we're going down a little bit further. On Friday, it's monthly OPEX. We got 435 and 440 call spread, and then we got 435 and 430 put spread. So what's interesting here, just looking at the chains now, is that again, this is going to be for Wednesday. It's very close in terms of volume, 80 and 80, and then 80 and 60. And why does this matter? Well, look over here. Again, these are still worth about 80 cents. These are worth about 70, but these lost $4 in value, which means the volume over here is actually a lot more impressive when we look at how much value they've lost versus what they've claimed over here. So again, roughly even. There's not a lot of, there is open interest, and the open interest is basically right around the same areas where we have volume, right? Nearly 10,000, 94, 94, 80,000, 80,000. It's like there's some kind of a system here. Yeah. And we noticed this the same thing going into last week. Again, I posted this stuff in Slack. Looking over to here, again, where's the open interest? Oh, 430 and 428. Yeah. So there's a lot of volume down here at 430, and there's it's too far out of the money now. 5-point drop is just too much. They burnt all this. Looking over here, though, we still got 7,000 here at 434. So what I'm just noticing is that there's potential, right? They basically wanted it at 434.5. That's what it tells me, right? 435 is kind of like break even. Sorry, 435 is max pain for right now if all this converts into open interest. I'm not sure it will. Looking at the chain for Wednesday, which is when we know that Jerome Powell is going to be talking, what's important here is just that, again, it's the same areas, 434 to 436, with the midpoint being 435. That's when Jerome Powell speaks. Looking over to here, again, we got 435 down to 432. So this is telling us the areas here. All right, tells us. We can also note that 435 is roughly $2 in premium, which is 433 break even. We got open interest down here at roughly 429 as well again. So there's open interest on the put side on Wednesday, and there's volume going into Wednesday. I believe the reason why there's the volume going into Wednesday, which is unusual, is that Jerome Powell is going to be talking. And again, looking here, we got the monthly OPEX. So it's not a weekly expiry, it's actually a monthly expiry on July 16th, which is going to be Friday. So what I'm noticing here is the exact same thing. From 435 up to 437, sorry, 435 up to 436, exact same thing, 30 and 30. We got open interest. The biggest OI on the 16s, or the 16 strikes, meaning 8 below and 8 above, is right here at 440. This appears to be a spread. Why? In volume, we got 36 and 35,000. So what that would mean is that the bulls want this to be all the way up here at 440. We can note what the cost on these 435s is as well. It's 260. What that would mean is that even with the move they've had up into Friday, these could double up to be worth about $5 by the 16th if they push it up to the top of the spread here and we close at 440. Looking over on the put side, again, we note that the volume pretty much comes in at the money here at 435. They've lost more than half their value. That's a big drop. The open interest here is not really evident until we get down to about 430. There's more below. I don't want to focus on that because we're focused on the 16s, which is the most probable range. But what I'm noticing is that, again, 25 and 20 at that same 435, 434, same thing we saw on Monday and Wednesday. And we're also noticing that there's a spread here, right? They're buying 435, 434, and down to 430. So it just tells us the potential. And again, if we look here, 435 has about $2 in premium-ish, right? We closed about 435, so it makes sense that, yeah, 435.50. So there's about 50 extra cents in premium, which should be added onto here, make them about, just over $2, and again, doubling up from 435 down to 430. 435 would be max pain by Friday, by the way, according to the volume, not the open interest. And then moving forward here, we have an August OPEX. What I'm looking at now is whether or not there's clues going out to the next expiry, meaning the next month in August. And what I look at here is I'm noticing that we appear to have the same type of strategy where they're putting on a straddle here at 430, right? 430 straddle means that we got about $11 and $6, about $16 in premium, which means 446 or 416. Yeah, 414 break even going into month of August. They're buying a little bit, right? We look here, we got roughly 18K, roughly an 18K, roughly 12K, roughly 16K, roughly same amount of volume at the same level with the same OI. That's a strategy to me. Looking over here as well, again, and note that we got that 435, 436 up to 440. So it just looks like continuation. Here's the buys that we have week to date, and the reason why I'm looking at this as well is because look at the numbers, right? They're buying the 433 July 30th call, and they paid about $4 for that. That means the break even when they bought these, and again, that's $13.6 million. That's not a small bet. They purchased these on Thursday. Look what happened on Friday. Oh. So they bought the 433 and 436. So they bought the 433 for basically $4, which would imply break even at 437. We're 1.5 points off of that by the end of the month. We can also look at here that the 436 has about 250 in premium, right? So again, that's roughly 438.50. We're getting pretty close to that 440 area by the end of the month, going into that August expiry. Okay, then we do have some bearish bets. Again, the put flow is going to be about 23%. Call flow is going to be about 77%. So it's clearly skewed bullish. But that's it. I'm going to go through the rest of the stuff inside of the private video because I'm just looking at time. We're at about 40 minutes. QQQ, same thing. I'm just going to point this out really fast here again. We noticed that we got the same thing. We got the 12th, 14th, and 16th expiries. Roughly the same area here. I'm noticing they're looking at betting here into Monday. Again, these are basically worthless now. I think this was insurance for what could have happened into Friday on the Joe Biden executive order. On the 14th, again, same volume, same strikes, same thing as Monday, same thing as SPY. Looking out to the monthly expiry, again, we see volume here at 355, follow through. So volume on Monday at 355, and then volume on Friday going at 355. I think Big Tech has a chance to actually push down. This looks like a straddle as well here, 355, 365. So what does that mean? Oh, and then like last thing here, Again, on the week, so week to date, 77% put flow for QQQ. They're buying longer dated ones too, right? August 20th, mostly August 20th. There you go. So what that could mean to me, just finishing off the story here, is that we could see more fresh rotation. What I mean by more fresh rotation is that as of right now, in the last 1 month, we see the pockets of deep green are very obvious. Apple, Microsoft, Amazon, Tesla. What it appears is that maybe they're concerned that this is too much too fast, and we're now going to rotate back where these are going to turn more red. Financials, healthcare, energy can start turning more green. I think that's what they're kind of looking at here. Might be insurance, might be bets. It's hard to know exactly what they're looking for. Seasonality chart, we already went through that. Bloomberg markets, we're going to have a look here really fast. And again, all these links will be in the description if you want to go back and explore on your own more later. And finally, again, there is that private video that will be shared. So if you want to have an edge, you want to get a little bit more of an advantage, come join us. What I would note here at first glance is that, again, on the 1 month here, all green. Net change, all green. Looking here at Europe and the Middle East, red. Asia Pacific, red on the 1 month. So red into Friday, red on the 1 month, green into Friday, red on the 1 month. The only thing that is still red for the American markets, again, USA all the way, is the NYSE. We're seeing that the advanced decliners is starting to flash a little bit of a warning. Why? Well, again, the market is rallying with only select names actually going. Most boxes are actually red. I believe the advanced decliner is about 200 advancing, 300 declining, which just means that we don't really have breadth and depth anymore. If this rally is going to be real, we need to see tech stabilize and everything else catch up, meaning everything else has to start turning more green. And that's what we are starting to see here. So, right, starting to turn a little bit more green. We have to see it turn even more green. Why? We need breadth and depth. It's not enough just to have one sector rallying. Economic calendar. I think I already got that up here. And we know the big day is Wednesday. So, there's not anything on Monday, so that's good, right? No potential headlines into Monday. Again, economic headlines. Doesn't mean there will not be headlines out. Economic headlines. Is this a preliminary number? Let's have a look here. So this will be a preliminary number. Why? It's the first time it's showing up here. So they've missed on the last one slightly, 18.3 versus 19. Now we're actually back down to single digits. So that's going to be coming out on July 14th. That's interesting. So what's also quite interesting about this is that that's going to be coming out Wednesday night. Jerome Powell is going to be speaking on Wednesday during the day. So what this could mean is that we're either going to be getting a double positive, meaning that Jerome Powell is going to be surprising, meaning that he's bullish, and then we get bullish continuation from Japan on their GDP and their industrial production. Or we could get one positive, one negative, or we could get a double negative. I don't know. Missed here too. So if we start getting negative news on Wednesday going into Thursday, we could easily see continuation. That's what it's telling me here. Initial jobless claims to seal it. BOJ monetary policy. That's going to happen overnight on Thursday. What are they going to say? I don't know. So what it just looks like is that starting on Wednesday during the market, during the cash market is when there is potential. So what I'll be watching for is weakness going into Asian and European markets, just because they close before we do. So what are they going to do in reaction to anticipate what Jerome Powell is going to say? And then how do they react overnight into Thursday? All right, now let's go through a couple of ETFs really fast here. I'm going to do these all on TC2000 just because I'm faster on here. So let's go here to my ETF list, and I'm just about done. I'll do the rest on the private video. So just finishing up here. It's been a 44-minute video, so pretty close to that 1 hour mark. I haven't been on in about a week, in 2 weeks though. So again, I'm gonna be a little bit longer here. Thank you for your support. Thank you for watching all the way through. Thank you for smashing the thumbs up, subscribing to the channel, and dropping a comment. Thank you, thank you, thank you. 10-year note is absolutely getting a pummeling here. It's getting a nice pump back up though. XLF, yeah, 3% day, right? Yeah, tech was down. W forming here, could easily push back to all-time highs, could also reject the 50 DMA here. FXI, big reversal here. Lots of gaps in the chart. Lower low, lower highs, looks weak to me. NYXBT is just finally starting to stabilize here. I don't know where it's going to go. It's stabilizing below the 200 though. It looks like an inverse head and shoulders is forming as well. XLE or energy, below the 50, but it's attempting to get back over. It just looks like it got a rejection off this this apex as well here. So going back all the way to, again, roughly our all-time highs. It's not a perfect trend line. Downtrend, lost it. Technically still trending up, but below the averages and actually lost that area as well. IWM, of course, right back up. So, oh, back above the 50 as well. So bounce off the green line again. Check, bullish. ARK, bouncing off the 200 here. Momentum might be back in play here. So what I talked about, when I mentioned that we want to see tech leading and momentum follow, what that basically means is that we're going back to risk on for equities. So we got tech leading. Apple's basically at a new all-time high now as well, after Amazon already did it. Yeah, Apple made a new all-time high on Friday, closing at a record here as well. So record high, record intraday level, it's into the promised land. And ARK is now potentially going to be starting to catch up. So if ARK can get back above about 132 on a closing basis, it might start making progress towards this gap at about 143 here. Emerging markets, not going anywhere in a hurry. Stuck between the 50 and 200. NYC, nice move. It's closer to the record now, right? Equal weight SPY, not at all-time highs here. So RSP is actually flashing us that the broader market, equal weighted, is only as bullish as it was before versus the S&P, which is squeezed significantly higher here, right? So we see clear divergence happening since basically the 24th of June. So what that means to me is that the broader market, meaning the entire S&P equal weight, not weighted like SPY is basically even here. So again, that's the breadth and depth we're talking about. DIA, inverse head and shoulders, cup and handle, ready for new all-time highs, it looks like. Record close. Nice. SPY, record close, right? New all-time high. SPY, I'll circle back and do a little bit on here, but I'm going to probably reserve most of this for the private video. Looking at 47 minutes now for this video. QQQ, strong. XLV, also strong. We noted that on the heat map. Gold, nice inverse head and shoulders here. So what I'm noticing on gold on the monthly is that it's doing what I wanted. It's bouncing off the area here. Note, this is a monthly chart though. These charts can take a long time to form. Our apex here is formed going into January of 2022. 6 more months. The fact that gold is actually on a sustained uptick as Bitcoin is on a sustained downtick is very notable to me though. XLU, bouncing up the green line, back over the red one. It looks good. Treasuries, rejecting here, right? Moving up, rejecting here. This is the 20-year note. VIX, whipsaw city. So again, that gap down on Thursday to the close on Friday, 23% move down. Yeah, they're doing a great job of killing options right now, right? Anti-life to the options. There we go, that's it. We're going to circle back on SPY now and get a little bit of a deeper dive. So looking at the monthly chart again, I think that we could push down to 415 to 420. What that would mean for me is that we're going to be piercing this this 50-day moving average here. Right now that's at 421.21. The longer we take to actually go back down and test this just means that if we do ultimately hit that 417.3 pocket, we are now going to be technically below the 50-day moving average again. Every time we've hit the 50, even if we reject off of it, it's been a strong buy. So if we came back down to that 415 to 420 pocket, I'm getting aggressive. I'm going to leave myself room to average in, but that monthly chart is flashing me that if we lose 423 or 428, so just looking here technically again, so we got our previous high right here in our previous close. Our previous high is 428.78. Our previous close is 428.06. Technically speaking, our low here is 427.52, which means we've actually bounced off this previous monthly top and close here. That's bullish. If we lose that 427 area, that's where we start getting a little bit of a concern. Second thing I would note is that over here on SPY, and again, pause the video if you need to go back and have a look at this. Why? I'm not going to go slow. I'm going to go fast. So pause the video, play it again if you need to. What I noted here, and if you've been watching the streams on Blaze Capital, is that I was looking for 427.5 specifically. Why? All-time high connect. all-time high connect, bouncing off a psychological 427.5 area, which is the midpoint of 425 and 430. So perfect bounce. The low is 427.52. You can't ask for a better setup than that. So that 427 area, not only did I know it was the monthly area, it was also the previous all-time high connect. So naturally, that's an area where we're going to see buyers, at least for a dead cat bounce or a knee-jerk reaction up. So monthly chart, bullish. Below 428, we're looking for that 421 strong support area. We got 420.01, and here we got 420.72. So I'm calling it roughly 421. It's also the open of this candle here. 422.6. What's also very interesting is that 421 is now our 50-day moving average, right? Oh, wow, 421.21. Oh, interesting. Interesting. That's interesting. It is interesting. Looking here to our weekly chart, if we were to extend this up, where does the top end of the uptrend land for us next week? Probably 440. 442.50. Oh, yeah. 7 points higher. Exactly. Yeah, 7 points higher, roughly 2%. So that's it. We have a, what do we got here? We got a low of 425.89, 427.52, higher low, higher high, technically bullish. Nothing to talk about here. On the daily chart, again, we had an apex here as well at 427 going into Friday. It only hit it on Thursday. So I'm going to clean this chart up going into next week. Strong though. What I would also note here is that what we can look at for the strength of this rally is just seeing what the candles actually look like. Looking back to here, again, showing some, so dip buyers are coming in. Wick. Even into the dips, we're seeing wicks and wicks. One red day, boom, right back up, which meant that the whole time here they were accumulating. So if they're accumulating all inside of this pocket here, if we go down, it would make natural sense they're going to accumulate more. Don't fight it though. Why? I believe that was monthly OPEX. Yeah, 618. So hold on. I can't remember if that was monthly OPEX or not. I know July 16th is. I believe that was monthly OPEX. So like, oh, monthly OPEX, yeah. Again, what do? They took it down into monthly OPEX. What are they going to do again? I don't know. But this right here looks similar, where again, on the Monday here, new all-time high. I don't know. So now we moved higher, 1 day down, gap up, push. Wick. Close higher. So like every day, people are just buying it, right? We're closing higher. We got massive wicks. What is that? It's bullish. The low here as well, we can see that we back tested the open. So gap's been filled. Let me actually double check that. No, so they dark pool printed it again. They've been dark pool printing like crazy. They want to make sure these charts do not have gaps on them. So they're dark pool printing all the time. However, what I would note here, again, we're looking at that 427.5 area. A lower low on the weekly is likely what's going to signify that we're going to push down to here. Why? Again, they're putting on that big straddle. So they're putting on a big straddle, which means we got to move 20 points. So 20 points down from here is 415. Oh, it is 415. Yeah, it's 415. 20 points higher, 455. Yeah. They're also buying the 450 calls for, I believe, for September, early this week. I don't have the screenshot right now, but bullish. So into the early part of the week, we're going to know whether or not that higher low is forming. Why? We have an uptrend right here, 428. That would be a higher low versus Thursday. Looking on the hour, here's where we start getting some clues. So looking over here, again, I'm going to remove all the trend lines. Again, what do we have? We got a cup and handle. We got a W. Call it whatever you want. Let's look down here at the volume, though. So looking back in time here, right? So moving higher, but with no volume. It does not take volume for us to go higher. The reason why the move is more violent, right? Here we grind up. Here we're pumping. So why are we pumping here versus going flat here? The volume. Buyers. A little bit of sellers, More buyers. More buyers and sellers are matched. A little bit of a push here, right? Ends up being a great dip buy. Then we get a big fat green bar. We finally got a red one again. What does that mean? I don't know. But the theme here is very obvious. Let's look back a little bit further and just see what the warning signs were here. So lots of green in here. We finally get a red bar. What happens, right? We tick down a little bit and start going flat. Okay, so if we see bigger red bars on the hourly chart, maybe we tick down or go flat. Yeah. That is it. Market moving news, S&P 500 charting. That's a wrap. Thank you for being here. Thank you for watching the video. I know it's a little bit longer than we had last week. Hopefully you're going to enjoy it. And again, a little bit longer to serve you as a template going into potentially the next 2 weeks. If you've enjoyed the video, I'd really appreciate a thumbs up. I'm going to make an effort to go back through and read and respond to every single comment to thank you. We're trying to grow this channel, and it might seem like a small gesture, but every time you smash a thumbs up, hit the bell, leave a comment, and drop a comment, that helps our channel grow. It literally tells YouTube that I like this channel, I want you to tell more people about it. That's all I ask in return. We'll keep doing these videos for free. The frequency will depend on how much people want these. With that said, I wish you all the best into this next week, into the next month, and as always, make sure you're being safe out there. Understand the risk and play within it. Actually, one more thing I want to go through here. So again, if you're brand new to this channel, maybe you want to consider joining us on Blaze Capital streams, where we actually have a lunch stream every single weekday. Monday to Friday, 12:15. I'd love to have you there. I look forward to seeing you. And otherwise, I'll see you in the next video next Saturday. Thank you very much.